So we're going to talk about a little bit the basics of an order book, how it works and what it is. Then liquidity, the first order benefits and second order benefits of, liquidity and having good liquidity. And then kind of like how we look at liquidity and how we assess it a little bit deeper than the metrics that we're going to look at today. But at least if you are someone that is looking for more trader insights of how liquid a market is, or if you're a token project and you want to know how much liquidity do I even have, and what do the metrics mean and what are good metrics and what are not good metrics, this is definitely a useful video for you guys. So to really go into the basics, because I've had conversations with people and they have barely seen an order book and what that means, it's really good to understand how do markets move and what kind of participants are in the markets. And that really, creates a good foundation to build on top of in the next couple slides. So I hope this doesn't look really unfamiliar for you guys. This is an order book. This is what most of the exchanges work on these days, at least the centralized exchanges, where you have the price in one column, you have the size in the token, and then you have the size in US dollar value or any other quote asset. Here, what we see is there are limit sell orders on the order book. These are people that have placed a sell order which has not been filled yet. And we have on this side, we have limit buy order books, orders on the exchange. And an exchange or an order book kind of works with two parties. You have a market maker, which is generally the party that has these orders on the order book, which has placed a limit order. And you have a market taker, which is someone that, just placed generally a market order in order to execute a trade. And for any trade to happen, you need to have two parties. You need to have a market maker, someone that is the counterparty of the trade, and someone that is wanting to execute the trade. Sometimes, for really, when I talk to my friends, they're like, oh, but you just press a button, right, and then you buy. But I don't understand that for every buyer, there needs to be a seller, and for every seller, there needs to be a buyer. And that's why we kind of have this order book here. All these orders here are maker orders. These are market makers. All these orders here as well. And whenever you as a trader comes in and place a market order, you're a market taker. And how that works is if you want to buy an asset, what is happening internally in the exchange is going to look for the first available sell orders on the order book in order to fill your trade. So let's say you want to, trade $10. The exchange is going to look for, oh, what is the first sell order? Oh, the first sell order is for $6 in total for this price here. We're going to take this off the book, and the seller is going to exchange the token to you, basically, and you're going to exchange back to him the US dollar value. That's kind of like how it works. It's just an exchange of tokens. But again, there needs to be a buyer for every seller and a seller for every buyer. But I mean, if now only this order is filled for $6, so you still have $4 to be left to filled, right? So this order is taken off the book, and it's going to go one order level up. And you're going to see that, now it's going to fill the other $4 in total, and you have just exchanged your tokens with two different parties, or one party that has two different orders open at least. So as you can imagine, it's really important that a market where there are no market makers, no orders on an order book, you can't transact in that market, or it's really hard to transact in a market where there are no counterparties, or not enough counterparties that have a lot of open orders on the book. And how I try to visualize this, and I think it's important to really explain a little bit, is with this visualization here, where we have a mid price, which is the price in between the best ask, the first sell order and the first buy order. This is the best ask, and this is the second order level, where the wider the bar, the more volume there is on that order level. And this is kind of like how I try to mimic an order book. So let me explain a little bit on how price then, moves. Why do we see wicks up and down? Why does price go up and why does price go down? And it is this is what market makers kind of like are involved in. So we have a basic order book here where it's just still nothing is happening yet. We have some buy orders on the book and we have some sell orders on the book at a price of $1 and $100.50. What's happening? Someone else in the market is placing a market buy order that wants to immediately buy an order. It takes this order off the book, it takes this order off the book, and it takes this order off the book, and then his whole order is filled. But that leaves a gap in the order book. These orders are taken off the book and will not be placed back, or could be placed back. And that leaves a gap here That means that the mid price is changing, which means that it was here before and now it's a little bit up, but the bids are still at the same level. Then in the second, what happens after, there are two things that could happen. Market makers like you and me could place these orders back here, which makes sure that the price is not moving up. But the second thing that can happen is that buyers realize like, hey, there's a lot of buying volume, for buying pressure, for example. We should move our bids up. And what happens in this case is that not that these sell orders are being filled here, extra putting on the order book, but the buyers are deciding to cancel these orders and putting their bids back on the book, but at a higher price. It is therefore important to understand that price can't really move up or down if not both parties agree that there's a new fair value of the asset. Because if these buyers here would just leave their orders on the book, price is unable to go up. Even though sellers are putting their ask orders way deeper in the order book. So again, someone is placing a buy order, sell orders are taken off the book because they're the counterparty to that trade, and buyers then decide to put their bids up, and that's how price kind of like moves up. And if it moves down, it's the other way around, where people sell, it takes bids off the book, and then people start to place their sell orders lower. Another way that price could move, which is less common, but could, for example, happen on the stock market, and you see a gap on the candlestick chart, is by, it can also happen in really illiquid markets where one market maker has full control over price. It's just simply where a market maker is placing bid and ask both on the book, cancels it, and just decides to put them at a higher price. This could, for example, happen. Let's say we have a closing day in the stock market, and the next day at the opening, they just start to place their orders higher than the closing day before. That leaves a gap on the chart, a gap in the market, which could happen because they both decide, the bid and ask, the buyers and sellers both decide there's a new fair value. And then, so I mentioned that maker orders that are on the book is really important. And I'll go a little bit deeper into why it's important right now. So to me, liquidity, what that means is the ease at which participants can buy and sell an asset in large quantities without significantly impacting the price. And in basic terms, what that simply means is you just need as many orders on the book on both sides as close to the mid price. So having a lot of open limit orders or volume in US dollars on the order book closer to the mid price. The closer these orders are to the mid price, the higher, the more liquid your token is or your asset is, basically. And there are kind of two things that we look at. And this is, when you assess liquidity, there are two things that we, from a first view, kind of look at. And it's the spread and it's the order book depth. And how any token project and anyone can kind of assess that is by literally going to CoinGecko, going to the markets, and observing the spread and the order book depth here. And I think it's important to understand, like, what does spread mean and what does order book depth mean? So if we have an order book here, let's first go into spread and explain why that's important. So if we have an order book here, you have the first sell order here on the book, and you have the first buy order here on the book. The difference between the best ask, the first sell, and the best bid is called the spread. And you can, put this as a percentage of the mid price, so the percentage of the price. And in this case, it's 84 basis points. And why spread is important is because, in my opinion, how I can explain it is like, it's almost the immediate cost that someone pays, regardless of the trading size, for trading an asset. And that is because, again, if you are buying an asset right now, you'll be paying, if it's a $1 trade, you're paying the price of the best ask. And if you would immediately sell the asset at the same time, you'd be getting this price here, at least if you're placing a market order. And that means you're losing 84 basis points directly on the trade, regardless of the size. And of course, it's really important to have, for projects to be attractive and for a market to have a really tight spread, because users, are happier paying less of a cost, having less cost for trading on an exchange or for a specific token. If this value is too large, people will not even consider buying your token because, they're losing the value the moment they click the buy button. For example, you have a $1 spread, for example, and you're a trader and you're placing a buy order, price has to increase by 1% before you start making a profit on your trade, for example. So there's not really a high incentive for people to engage in your token because they lose value right away. So this is kind of like the startup cost. The second thing that's important is the order book depth. And what we look at is the +2 and -2% depth. Simple terms, if you have the mid price, and explain it a little bit, if you have the mid price and you get the price 2% above that, how many US dollars value of limit sell and limit buy orders are on the book there? And this is kind of what that looks like. So if we calculate the mid price, so the price between the best ask and the best bid, we get this price here. If we then calculate 2% above that, we get this price around here, which in total involves these first 3 order levels. So within the mid price and the price 2% above that, there is in total $2 + 14 + $19 in US dollar value of open sell orders, which in total $35.32. And what this basically means is that if I would place a trade, and this $35.32 is the same value as you would see in this column here. So this is how much volume is there between the mid price and 2% above that. And the -2% depth is the mid price and 2% below that. What this means, if I would be placing a trade of $35.32, what would happen is I would place a buy order. It would take this order of the book. It would take this order of the book. And it would fully take this order of the book and a little bit of this order. That means that I'm paying up to 0 to 2% extra for making this trade. So by trading in larger volumes, and because there's not a lot of liquidity on the market here, not a lot of volume, I'm paying up to 2% more for buying that specific asset than the fair price indicated, which was the mid price. What that means in this case, if I would be buying on the exchange here, an order of $70 will cost me up to 2% more than the fair price that is stated here. That's kind of how you can see it. So when we're talking about order book depth, I mostly talk about, the additional cost of buying and selling in large numbers. So where this is the immediate cost for any trader, regardless of the size, there's an additional cost added on top of that for trading in larger quantities. So ideally, as a market or an exchange or a token project, you want to have the highest value here, because the larger the value, the less the cost is for the trader, the more likely people want to engage in your project because they don't have to pay additional cost. And I mean, for the retail trader that's trading with $10, $20, this is not highly important, right? But I mean, if you want to attract investors or people that need to stake a significant amount of money to secure a network, you need to have a decent amount of liquidity so they can easily interact with buy your token or sell your token and interact with your project or whatever you're building. An example for Bitcoin, and I mean, this is, of course, when we were talking about the project that we interact with Hummingbot, there might be a Bitcoin, but there are also sometimes really small cap tokens, which look more like liquidity that we see over here. When we're looking at Bitcoin, there's in total of within the price and 2% above that, almost 23 million of liquidity. That means if I would be placing an order of 23 million, a buy order, I mean, I don't have 23 million, but if I would be paying a price in between 0 and 2% more than the price that is stated here. So that's an additional cost that I'll be paying for trading in large quantities. So trading in large quantities, normally when you buy in bulk at a store, you're getting discounts, right? But in crypto, it kind of works the other way around, where you pay additional costs because there's slippage happening on the trade. The larger the larger volumes you trade. Let's see. Yeah. And I think this is what it all comes down to. So all these projects, they're potentially highly focused on, marketing, and they want to get as many exchange listings as possible. And in my opinion, is an exchange listing something that is a form of marketing, because they get exposure to new, people that can adopt the token in a way. But the thing they don't do is focus on liquidity. And what I always explain to them is like adoption is a function of fundamentals. So being a really good project with a really good use case, multiplied by marketing. So people can actually know your project and know what you're doing really well. And the third thing that is often overlooked is liquidity, because without liquidity, people can't really buy your token and interact with the project that you have and have, use it. And then again, without fundamentals, no one will even consider you because you're just like a project that is, doesn't do anything useful, basically. Without marketing, no one will know you. And without liquidity, no one can participate because they can't buy your token easily. And again, it's an equation, right? So you can have a 10 out of 10 on fundamentals, a 10 out of 10 on marketing. But if your liquidity is just not there, a 0 out of 10, I mean, the outcome of the equation is still 0, right? And you can have really good marketing, really good liquidity, but really shitty fundamentals, and you barely get any adoption. I mean, this has with some projects proven to be wrong, that even though weak fundamentals, good marketing, and good liquidity still, have adoption. But generally speaking, you need everything, and you can't say like, oh, I'm only going to focus on 2 out of the 3, because that doesn't make sense. Focus on all 3, and that gets the most the best outcome, basically. And that's, so when I talk about liquidity, you kind of have the first order benefits and you have the second order benefits. And with first order benefits, I talk about that liquidity is a necessity for a project in order, to get adoption. It's also a necessity for an exchange, because if you don't have liquidity, no one with a decent amount of capital will come to your exchange and start trading on it, because they have too much slippage on the exchange and they're better off going to Binance. So liquidity is a necessity, and that's the first order benefit of hiring a market maker or making sure with some kind of like tools that you have liquidity. But there are also second things that come into play when you have liquidity. That's going to be easier at one point. First one being that, if you want to get listed on a second exchange, that exchange will look at your liquidity on the other exchanges. And if they see that you have a proper amount of liquidity in your token project, you will get cheaper listing fees on the exchange. And it will also become easier to get listed. I mean, even especially in the bull market, when you have a decent amount of liquidity and you're a good project, exchanges will ask to list you more easily than if you don't have that amount of liquidity. It's also, if you have a project that is, has a lot of liquidity, or you make sure there's a lot of liquidity, it's also more interesting for investors, especially whenever they get some kind of like token option when they, that are unlocking at one point. The investor, if they get 20K of tokens worth of tokens at the end of a specific period, they want to know that they can at least sell it to someone. And if there's no one to sell it to, what is it then worth, actually, those tokens? So you're going to be more interesting to investors. The third thing is kind of like what we say is liquidity breeds liquidity. And what we mean with that is that if you make sure that there is liquidity allows volume to increase, because it's more, favorable and easy for people to interact with the exchange and your token. So volume will increase, which in turn then will, attract other type of traders that are going to put limit orders on the book. It might attract one of you guys that thinks like, hey, I can do cross-exchange market making on this pair. Or, hey, I start providing my own liquidity for this pair. So and that's kind of like how that circle goes. Like, you have liquidity, it's going to be more attractive for other traders to trade on, which increases liquidity. And it's kind of like a circle that goes on and on. Or even at one point, there are probably some markets that don't even have a market maker anymore, because they just have really good organic liquidity. But in order to get that, you need to have, you need to provide liquidity with some kind of tool, Hummingbot or a market maker or anything else, before you can get there. And the fourth one is basically you reduce volatility and you make a chart look way better. I mean, we saw the first chart that I showed with those big wicks. That's not really appealing for people to like trade on, or be like, hey, I'm going to buy that token. And if there's no order book depth, there are no orders on the book, it's going to be really easy for people to push price down and push price up, which there's a lot of volatility, which is generally for the retail traders, especially if you want to attract retail traders, not really appealing, because they can't really handle volatility. Last couple slides. So when we talk about liquidity, there are a couple things we look at, and we first of all look at CoinGecko ourselves, and then we have an internal tracking tool. So we first look at spread. We don't look at spread as a snapshot, because CoinGecko, what's important to understand, is a snapshot that is taken, I think, like every 5 minutes of the order book, and those, you know, it calculates the order book depth and it calculates the spread. What we look at is spread, not as a snapshot, but we have it in a dashboard over time, and we look at order book depth. And there are two things important with order book depth. It's the availability. So how much liquidity do you have within 0 to 0.5%, 0 to 1% of the mid price, and the 2% to the mid price in general. And then the second one is really important, is consistency, because what we sometimes observe is that, you know, there's $2,000 of liquidity within 2% most of the time. But then suddenly, I don't know what their market maker does, but they stop providing liquidity, and all of a sudden there's only like a couple $100 left. So it's not only availability, generally how much liquidity is there, but also the consistency of liquidity. There are no certain drops in liquidity sometimes. And then the third one, which is really important, that's kind of like the summary of it all, is when you have a really tight spread and really good order book depth, which is with a lot of availability and consistency, you will see that other people that are trading on the market have the least amount of slippage. And that's kind of like a result of having really good liquidity in your market. A tight spread, really good depth, which is available and consistent. And these are the metrics that we track internally as well. And this is actually something that I'm gonna, because we use Hummingbot as kind of like the backend for this, to compute all these metrics and send it to a database. And that's something that I will be talking about in future sessions. But simply what you can see here is a candlestick chart, spread over time, trade slippage in like a histogram for a specific token, trade slippage over time, so you can see when it actually happens. And then we compute the 0.5% depth, 1% depth, 2%, and 5% depth of the order book. Last couple comments. Yeah, liquidity, you know, when we look at Bitcoin, like that should not be your aim specifically. Liquidity should kind of grow with the maturity of your project. The bigger you are, or the more mature you are, the more liquidity you probably need. And it also heavily depends on the use case of the token, right? Because I was talking to a project, and I think on average people were staking $400 of liquidity, $400 of the token in their liquidity pool. And then you need to have at least a decent amount of liquidity for people so they can easily buy $400 of the token. While if your use case is, for example, securing the Ethereum network, you probably need way more liquidity than that. Or if your token is mostly used by retail traders, you might not need as much liquidity as if, you know, it's mostly, you know, bigger investors or bigger players that are buying the token. You probably need more liquidity. Second thing, and I think this is an important one, is make sure you have liquidity on every exchange first, or the most important one, before you do a new exchange listing. Because again, when we look at all these new exchange listings, they are listed on a couple exchanges. They just added a new one. And if we look at all of those exchanges, the liquidity is just not good enough. And it's kind of, again, without proper liquidity on the exchange, it is almost worthless, because you can be on an exchange and offering your service, offering the token, but if no one can easily interact with the token, easily buy, no one will actually do that, or not no one, very few people. Last one, don't focus on 24-hour volume too much, but focus on liquidity, for the reason that if you have proper liquidity, 24-hour volume will follow. And it's not the other way around, where if you have good 24-hour volume, you all of a sudden start to get liquidity. And the second thing is this doesn't look right? Like you can tell me that you can have almost 300K of trading volume within 24 hours, while you have a spread of 1.45 and you only have $105 of liquidity within 2%. So please focus on liquidity first, and then 24-hour volume if you're a token project or exchange or anyone who is interacting with tokens. And sometimes take these things with a grain of salt. Cool, guys. Enjoy your weekend.